Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Happy holidays and welcome to our December monthly research briefing. CAPIS would like to thank all of you for taking the time out of your busy day to spend with all of us here. We hope you find the following information in today's briefing insightful and that it sparks debate about the capital markets and trading strategy. Also, be sure to take a look at our new website, www.capis.com, and explore our products and services there, as well as follow us on our social media platforms, LinkedIn, YouTube, and Twitter. And you can catch our day-to-day content offerings. But as always, before we get started with the briefing, let me run through the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now on with the briefing. I'd like to turn it over to our special guests, Markets Policy Partners. But before I do, please note that John and Brendan will be taking questions at the conclusion of their remarks. Please kindly type them into the Q&A portion of your Zoom, and I will be sure to get to them, and they will get you an answer. And now I'd like to introduce John Fagan. From 2014 to September 2018, John was director of the U.S. Treasury's Markets Room, and prior to that was a senior macro strategist for Discovery Capital Management. He was primarily responsible for Asian equity indexes, foreign exchange, and the rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law. And now for Brendan Walsh. From 2006 to the summer of 2018, Brendan was a senior analyst at Discovery Capital Management, covering global financial institutions, and was part of the global macro team, focusing on macro data, rates, foreign exchange, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development, and was an International Travel Fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, as always, welcome.
Thank you very much for having us. We always enjoy coming on and appreciate the great questions we get at the conclusion of our remarks. So thanks again. It's been a long and winding road this year through the macro landscape. And just to pull the view back, coming into this year, our view had been that the first half, it would be a year of two halves in 2022. And that we would have a very challenging first half of the year and a better second half of the year as inflation peaked out and the Fed began to downshift its tightening cycle. That we were a little bit early on that viewpoint. The Fed downshift and the peak of inflation came a little bit later than we expected, but has delivered a little bit of lift in the equity market, and risk assets calmed down the Treasury market and the dollar through the last couple of months or so from the end of September. Is this, and the big question, of course, now is, are these more, positive trends going to carry further into 2023? And I think maybe an analogy, without being too dramatic, I think our analogy is that this is something of the eye of the storm that we're in right now. And early 2022, we were buffeted by winds of, the inflationary and global central bank tightening storm that hit financial markets. And as inflation has pretty decisively peaked out here, despite the Fed's sort of hawkish atmospherics, they are downshifting, and global central banks are doing the same thing. We're also seeing some other positives. Obviously, the dollar has come well off its highs. We've seen oil prices calm down. I mean, they've practically halved from the highs of the spring. China is rolling back COVID zero and seeing some infection.
Maybe accelerating that, yeah.
Blow back, but they'll get through it, and they're beginning to stimulate the economy more vigorously there. OPEC didn't double down on its supply cuts at the early December meeting. The U.S. policy and political uncertainty is, we would argue, lower, not entirely gone, obviously, but lower after the midterms. We have some additional clarity on the outlook there. The Russian invasion of Ukraine, obviously, still a festering sore on the global scene, but not currently in an escalatory kind of mode. And knock on wood that it stays that way. And the last but maybe not least, the crisis in crypto hasn't really metastasized into something that is clobbering broader risk sentiment. Although it is a headwind, it's certainly a negative and a drag, and it's certainly in certain parts of the equity market and other asset classes. But it hasn't been a really destructive force for broader sentiment. So with all of those kind of factors together, we expect that this kind of eye of the storm that we're in right now can persist through year end and into first quarter. But the sort of back half of the hurricane, I think that we're focusing on is the winds kind of blow in a different direction in the other side of the eye, and we think that the different direction we're going to get really is the transition from concerns about inflation to concerns about recession. We're seeing a little flash forward on that today in financial markets after the lousy U.S. economic data that came out. And we think that is going to be compounded not by more Fed tightening or central bank tightening, but instead an unwillingness to cut. And we think that, when we look at the macro landscape, one of the biggest divergences and divergence that widened yesterday after the dot plot came out and the guidance was delivered, that the Fed fund futures and treasury markets are basically in, outright rebellion with the Fed's longer term view and pricing in substantial cuts in the second half of next year, which we think the Fed will be very, very hesitant to deliver, very wary. So we'll get into a little bit of that. So I wish we had a better outlook. We think that there's still room to run with the relatively better kind of market dynamics that we've had over the past couple of months, and we think that can persist into the first quarter. But as I said, this back half of the storm kind of dynamics with growth and lack of stimulus in terms of monetary and fiscal. Where does growth come from? How do we restart the engines? I think that's going to be a big question for the back half of next year. So just looking, particularly at the Fed, the equity market obviously is taking the Fed maybe more seriously than the bond market.
The bond market, yeah.
Look at the Treasury. The Treasury market basically just laughed him off, and there is an element, I think, that Fed Chair Powell, there's an element of gamesmanship in his communications. I think we're all we've cottoned on to that. If he's trying to raise up the ante because he wants he doesn't want this is a verbal fighting retreat from the tightening cycle. He doesn't want this taper and this downstep in the tightening pace to be the source of too much loosening of financial conditions, and so that leads to this.
They're targeting the S&P with their verbiage. They
Right.
They know what they need to do, that they've already over tightened and need to try to save face and slow down. But they don't want the equities to rally, so they're doing everything, because the dot plot yesterday was comical. Like it's like, have you been outside today?
It's totally incompatible with their economic forecasts too. I mean, it doesn't make any sense.
No, and the economic forecasts don't make any sense either.
Right. And so there's so it's that element of gamesmanship, a little bit of kabuki theater, hand waving, and trying to convince the markets that the Fed is going to be still in the tightening game for a lot longer. We think that they maybe get in one more 25 basis point at the early February. Can they do a final kiss goodbye, another 25 basis points in March? Maybe, but I think the reality will be pretty clear by the February meeting that the tightening cycle is at or very close to its peak, and the focus will then shift to when is the Fed going to cut, and
the Fed will have the same way that they didn't understand their housing component of the CPI, when it was deflationary, they didn't understand in the second half of 2020 that it was going to be hugely inflationary because it's a 6-month rolling average. we know from the real-time data that the housing prices and rents are falling rapidly. So that's about to be reflected in the data come, March. So we really did print a negative print if you took out the housing component, but the housing component is going to start actually being negative. So the month over month prints, in the middle of 2023 will be deflationary. So they're going to be fighting the exact opposite thing that they're fighting today.
Yeah, I think that it's going to be increasingly, our view is that it's going to be increasingly as frustrating as the Fed is now, this deliberately obtuse kind of Fed posture where they refuse to see the improvements in inflation.
I did an interview with a newspaper yesterday, and I said, Wayne Gretzky skated to where the puck was going to be. The Fed not only is skating to where the puck is, they're skating to where the puck was.
Yeah, a couple of months ago. And we think that obtuse Fed posture is going to be increasingly frustrating, even though in the first quarter, you're going to have this moment where, the economy is not in a recession. We don't think it's going to be in a recession. We don't think it's in a recession now. We don't think it's going to be in a recession in the first quarter. We think there's going to be enough mixed evidence that it's possible that even despite the Fed's hawkish communications, that the real, the downshifting of its policy is the reality. Watch what they do, not what they say. And their, hopes will, I think, be able to percolate for a soft landing in the first part of the year. But we think that slowly evaporates. And the Fed, in the face of all evidence of improving inflation and in the face of increasing evidence of a relatively quickly deteriorating economic picture in the U.S., maintains their tightening, their plateau of rates at the 4.75 or 5%, suboptimally high, and keeps it too high for too long, and denies the economy and financial markets the kind of relief that they need and would need for a decent rally in that mid-year kind of back half of the year.
The Humphrey Hawking's testimony is usually kind of a boring one, but the next one's going to be a fun one to watch.
Yeah, and so if there's one thing that obviously every morning Jay Powell wakes up and looks in the mirror and says, "You're Paul Volcker," or "You're Paul Volcker," and the one kind of message from Paul Volcker's 70s, 80s Fed is don't cut too early. It doesn't really deliver, and that is the gospel of Volcker, and I think that is going to keep that mantra that the Fed is going to be repeating to themselves: don't cut too early, don't give away the gains in inflation fighting that you've achieved. I think that is going to be a very, very challenging formulation, and we expect that to be a challenging formulation after this eye of the storm and passes, and we get into sort of spring, summertime. And U.S. growth and global growth is still quite poor and deteriorating, and inflation isn't at target, and the Fed persists in denying rate cuts. A dismal outlook. What are some counter-cyclical possibilities? China, we mentioned that this kind of eye of the storm, one of the positives is China rolling back the COVID zero, and we're seeing the spike in infections. We think obviously this plays through. We know how this works. In the rest of the world, it's a very difficult process in the near term, but on the other side of it, you get successive waves, but ultimately, it allows you more of a return to normalcy than the COVID zero draconian lockdown sequence. So net, that's a good thing, particularly over the medium to longer term. Are they stimulating the economy? Yeah, we saw that in the aggregate credit numbers that have come out. Do they have to do more? It would be nice if they did more. Those aggregate credit numbers.
We're starting to hear leaks, out of the government that's what they're contemplating. So we usually do it.
We've really got to see it, and that is the thing that we've seen again and again. China's periods of stimulus since almost since the 2009 just blowout stimulus that they did after the global financial crisis. Each successive episode of stimulus has been a little bit weaker, and now they kind of tend to talk a good game, but not necessarily have a lot of follow through. We think that there's going to be some impetus, but maybe more of a stabilization to slightly better rather than a real, roaring higher. And the increasing bifurcation of the global economy into a U.S. and China block basically, I think, dulls some of the positive impact that a Chinese bounce back in growth would have on U.S. financial markets, because we are increasingly, we're in the process of a divorce, and the positives in China will feed back less positively on the U.S. because of the balkanization of global supply chains and trade.
Yeah, and that's just accelerating. Every day we get a new announcement of someone reshoring their chip production, their manufacturing, and it's not even just going to Vietnam. It's coming actually here to America.
Yeah, and it's bipartisan. We'll talk a little bit about U.S. politics in a bit, but it's something that U.S. I mean, just aside from the partisan warfare going on in D.C., there are some undertones of real agreement, and China is one of them. And that is not going to change in the near term, in our view. Oil and commodities, obviously, the oil prices have almost halved. We mentioned that as in our sort of list of positives for the immediate and the very near term market dynamics. We think that OPEC is vigilant. We think that Russia has not given up the idea of oil as a weapon, and the Strategic Petroleum Reserve needs refilling. The Biden administration said they would fill it south of 80, and so we think that is that's kind of the floor. And even as global growth begins to worsen next year, we think that some of these countervailing dynamics will keep oil prices and the upswing, relative and asynchronous upswing in China keeps oil and commodity prices relatively better supported than they might otherwise be. But the sort of sting in the tail there is that keeps inflationary pressures at the forefront of the mind of Fed officials, and they don't want to release the animal spirits in the commodities markets when oil prices are still hovering in historically relatively higher levels. And just on the subject of U.S. political and policy uncertainty, the market obviously been leaning into a divided Congress, and despite the lack of a red wave and all the different takeaways that people had from the midterms, it's divided. Guess what? It's divided Congress, very finely divided Congress. Are they going to get a whole lot done? No. Is that bad for financial markets? No. But that's another. It denies any opportunity for fiscal stimulus next year. So monetary stimulus and fiscal stimulus, we think, will be very much lacking in the U.S., and it'll be hard to find catalysts to restart the engines of growth next year. But overall, the policy, the areas where we think that bipartisan cooperation can occur would be in like a stablecoin regulation, maybe crypto. Although, and we'll talk a little bit more about this in a minute, but I think there's a sense right now on Capitol Hill that they want to let nature take its course, and that like the stuff happening in crypto right now is so fluid that they don't want to jump in with like a legislative solution that would not be fit for purpose after after these events kind of
literally
play.
Yeah.
But stable coins are very different, and so we think that something on the stable coin and obviously continued potential legislation regarding the U.S. China and codifying some of these national security and commerce related China countervailing aspects. We think that is another area where there can be bipartisan cooperation. Is it possible to do something that is that's everything we think in terms of like infrastructure, and they got a lot done in the first 2 years of the Biden administration. So a lot of their energies are going to be going into executive and execution and so forth. And certainly the House is going to tie people up. If you're looking for political and policy uncertainty, I guess you'd have to point to the debt ceiling. We're not totally convinced that it's not going to get like, that it's not going to get, raised on the last day of the Congress before everybody blows out of town. It's kind of one of those. Now that they've got like agreement on the omnibus spending bill, it looks like they're going to keep keep a government shutdown from occurring tomorrow. Maybe they sneak in at the when all is said and done on that front, then they can maybe sneak in a debt ceiling lift. But the base case is that this comes around next year and turns into a potential showdown, potential food fight. Markets tend to ignore it. We've seen this movie before. But watch this one because the trenches are dug a little bit deeper, and the stakes are potentially raised a little bit higher. So does that, when is the 0 day? The idea is that all of the debt ceiling probably needs to be raised by the summer. And so that sort of coincides generally with our view that the eye of the storm passes over us and we start getting into really choppier waters in spring and summertime in financial markets. And then just lastly, in our comments, FTX. It's and there sure look like there are more shoes to drop. This the more everybody finds out about it, this doesn't look like honest mistake. And there are plenty of conspiracy minded ideas on exactly what transpired, but the long and the short of it is, on the positive side, it hasn't become a domino effect into regular and normal sort of equity markets and other markets in a systemic way, at least not yet. Are there other shoes to drop? Yeah, there are, obviously, the withdrawals at Binance or however you pronounce it, and Tether, obviously, breaking the buck at Tether would be another big shoe to drop, and we think that's probably coming. What on earth is this SBF guy going to say, to prosecutors? Is he going to sing like a canary and like blow the lid on all of the stuff that's clearly going on behind the scenes? Probably. So,
well, the jail in the Bahamas is the worst jail like on earth.
Real bad.
Yeah, real bad. So he could be singing very quickly.
So, yeah. And so obviously as we mentioned, on the regulatory front, to push through regulation right now that would be, that would give clarity to which agency has responsibility for crypto and that sort of thing. Most of what we're hearing from Capitol Hill is that they're very wary of doing that because legislation would look like there's some sort of legitimizing that Congress is legitimizing crypto, and they don't think that this is a good time to be making that kind of statement. So the optics are bad. But also, if you make legislation now before all of these other shoes that we've mentioned have dropped, it may not be very fit for purpose in the landscape of crypto after, nature has taken its course, so to speak, in some of these other cases. So there's a sense that, they're going to hang back. They're obviously, the SEC is more empowered to do enforcement. And that's really what we think. It's going to be regulation by enforcement for the near term in crypto, rather than something that is really coherent from Capitol Hill. But as we said, we think stablecoins are in a different category and get legislative and bipartisan legislative treatment. Is there anything else we should go over? Let's open it up for questions
about the euro, where we think the euro kind of does in 2023.
Yeah, we have that question here. You see that, Brendan?
Yeah.
Okay, yes. Good. We'll answer that one then, about the balkanization in the Ukraine, and where do you think the euro will be relative to the dollar?
So our basic view on the dollar for next year is that the expectations of Fed rate cuts in the second half of the year, which have taken the wind out of the dollar sales, are going to be really hard to disabuse market participants of that notion, no matter what the Fed says. And as we think that it's going to be, we think that the risk off that we expect in the spring, summertime, as the recession begins to bite, the lagged effects of tightening, the lagged effects of the dollar spike this year really begin to feed through into economic activity. We think that kind of dynamic gives the dollar a little bit more of a rebound, but we don't think it takes out the generational highs that we saw in September of this year. We think that the European Central Bank will have a they've got a even tougher time than the Fed. I think that they're just going to follow the Fed's lead. We think that this mirroring behavior basically creates a range trade for the euro, and the question about the Russia-Ukraine situation. Our expectation on this is, and how it feeds through, there's a lot of concern about everybody thinks that Europe is going to be fine this winter. There's a lot more concern about next winter, and there's going to be, a scramble to get supplies and make sure that they can keep things going for the long haul. Can the euro float through that? We think that the European Central Bank is, they've got the bond market to worry about, and so they can't be as aggressive in inflation fighting. We think that inflation will remain sticky, particularly in Europe. It'll be a very stagflationary environment. We think that the European Central Bank mirrors the Fed. The euro stays range bound. The conflict in Ukraine remains, a frozen, a bloody stalemate in the east, with the two sides. Russia having enough wherewithal not to lose, but certainly not to win or make significant gains. We think that there's a chance of, escalatory kinds of dynamics, but that are more, on the less large troop movement and more, targeted terror kind of approaches in civilian areas and against Ukrainian leadership. That's kind of what we expect. And it's a dismal and awful picture, but it's better than perhaps a truly escalatory aspect.
John, we got another one from the audience, and they're asking, what will it take and how long will it take for the yield curve to normalize?
Yeah, the disinversion of the yield curve, we think that it's going to happen through this process of, we think that the yield curve begins to disinvert as this negative scenario in the spring, summertime plays out in the US. And the Fed's, we think that the Fed will as they continue to tell the market, we're not easing, don't expect rate cuts. The market is going to be, that communication is going to be less credible as we get further into the summer. The less credible that kind of communication becomes, we think that feeds in the back half of the summer, sort of back half of the year, a disinversion of the yield curve, as basically the rate cuts are deemed to be a fait accompli, at least by later in the year. And basically you get this summer to second half of the year disinversion of the yield curve as expectations for a modest rebound in 2024, I think, take hold. So the yield curve right now, there are obviously a lot of, it's screaming out a recession signal. We take that very seriously. The Fed doesn't seem to be taking it as seriously. And we think that the disinversion occurs as it normally does, sort of in the process of the recession taking hold.
Okay, I don't see any questions. We'll give them a last minute while I start reading the outro, if that's okay. So first of all, again, we'd like to thank Brendan and John for coming to the briefing today and providing.
Wait, I've got one last point. We didn't talk about.
Sure.
We've had a lot of conversations about 2024, about the presidential about the presidential race. Since we're in DC, we got to talk politics, so that we can close with that. The scuttlebutt obviously is about DeSantis, right? Trump had a lousy midterm. His candidates didn't do well, and there's a lot of soul searching in the Republican Party about candidate quality over whether DeSantis is, now that DeSantis had a great midterm, and whether he should be the anointed one. There's the reality is Trump is the kind of guy that's unwilling to go away, and if you're DeSantis, your choices are essentially, enter into a bruising fight for the Republican nomination, and just a knockdown, drag out primary with someone that was your mentor. And it's a hard thing for you to say bad things about him, because he still has a very strong hold on the base, and you have in some ways become the sort of standard bearer of his legacy. So it takes a lot of political gymnastics to try to beat that, try to win against that. And then even if you do win, is Trump going to run as a third-party candidate? I would say yes, he's going to run no matter what. And yeah, they always say, oh, a third-party candidate isn't going to have, the support of a major party. You can't pull it off. He makes his own economics.
It's just a unique scenario.
Yeah, and he's got to do it for obviously personal reasons, but also potentially as a hedge to his legal woes that are deepening by the day. And so, if you're DeSantis, even if you get through the midterm, you're going to have to face him in the general, and he's going to take a good chunk of your voters away from you, and you're going to lose almost certainly. What's he going to? How do you get past that? And so there's a lot of discussion in the Republican Party about how is there any sort of viable way to put this guy out to pasture and to move to the next generation. And right now it's definitely not apparent. The scuttlebutt, obviously, from the White House is that Joe Biden believes that he alone matches up very well with against Trump, and it is his responsibility to the country and to defeat President Trump, ex-President Trump, if he runs again. And but if Trump for some reason is out of the picture, then we do expect we do expect that he would step aside. And talking about the sort of parlor game of who might it be, and that sort of thing, it's obviously way premature. But people talk a lot about there's obviously Newsom in the conversation. There's the governor of Colorado. What's his name? Just escaped me. But Whitmer, the governor of Michigan, is also another potential candidate. Pete Buttigieg is also in the conversation. So there's notable in the absence from the conversation, obviously, is Vice President Harris. But we'll leave it at that. And so it is a very topsy-turvy political picture for 2024.
Thank you for giving us that little bit of update. I know some people within CAPIS would be very curious to see how that goes. And I think DeSantis definitely has an uphill battle facing him in dealing with Trump, because you're right. You can look back a couple of elections, when the Republican Party again was kind of split, and the third party candidate siphoned away votes from George Bush. I'm having trouble remembering his name, and that's unfortunate. But it was one of those moments where, an election.
Yeah.
That's it, Ross Perot. Thank you.
Yeah.
And that's where the Republicans lost it, I think, because didn't Perot get something upwards of 20% of the vote?
Yeah, he got a lot of votes.
Yeah.
Had a lot of votes.
Trump would definitely get that.
Yep.
Yeah. So that's certainly in the cards. There's also the sense that DeSantis also hasn't been tried on the national stage. He's done great in Florida, right? And he's turned Florida dead red. But there was I was listening to some political commentary, and someone mentioned, hey, remember when Scott Walker was like anointed as the chosen one, and he gets up on a national stage, and everyone, he just didn't play on a national stage. And so does DeSantis play on a national stage? It's an unanswered question at this point.
All right, there's still no question. So wait, we have one more that popped in. Oh, someone just says Ross for boss. That's a good one. We'll end that with a little bit of funny business there.
Admiral Stockdale was his VP, right?
That's correct.
I remember. Oh, Admiral Stockdale was ill-served by the political process. A real American hero, but boy, he was not ready for the debate stage. I remember watching that when I was in college and feeling for the guy.
Yes, indeed. Well, I'm glad that we could end our final briefing of the year on a good note, on funny note. Thank you, John and Brendan, for coming and presenting here today at the December CAPIS research briefing. So we're going to conclude our program now, and our next research briefing will be held on January 19th, which will feature our fundamental analyst, JC Peretz of All Star Charts. So stay tuned. Again, keep up with CAPIS on social media, LinkedIn, Twitter, and the CAPIS U channel, as well as keep up with the guys at Markets Policy Partners. They have their own YouTube channel, LinkedIn, and Twitter feed, so give them a look as well. And in behalf of CAPIS and Markets Policy Partners, thank you so much for watching. Happy holidays, and have a great trading day. Thanks, guys. Take care.
You too.
Thank you.